Hi, I'm David Scranton, and thank you for watching, because today we're talking about the markets and also giving some predictions for next year as 2021 comes to a close. And with us, we have Eddie Ghabour. He's the co-owner of Key Advisors Group in Delaware. He's also the Amazon best-selling author of the book, The Common Sense Bull. Eddie, always great to have you back on the show.
Thank you, Dave. It's a pleasure to be here with you.
So, all right, talk to me here. 2021, some components of it were predicted, others were a complete surprise for many. What were the biggest surprises in 2021 from your vantage point?
I think the biggest surprise to people was the rate of change of inflation for 2021. They continued to hear the fact that everything was transitory, and they didn't think that inflation was going to become an issue because we haven't had really high inflation, if you think about it, since the late 70s, early 80s. So everyone continued to put that aside. So I think inflation was the biggest surprise. Obviously, it was a surprise to the Fed. But I think to just everyday people, when they look at the cost of living today versus where it was 12 months ago, it's a significant difference.
Okay. So as an income specialist, then how are you dealing with that right now for your client, on behalf of your clients?
So the unfortunate reality is, some of the fixed income markets have been challenged because of this low rate environment that the Fed, I'll say, has manipulated with the bond purchasing. So one of the things that we did is we actually, for 2021, I will say we were almost forced to take a little bit more risk than we normally would because we wanted to get some yield. So, having more individual stock exposure than what we've had in the past, and really trying to focus on quality companies with dividends. But from an equity style perspective, we had to increase the equity exposure for clients to get a little return. So that was one of the biggest things that we had to do in 21 because of how low interest rates were and how challenging it was for some aspects of our asset allocations.
Now, I know we spoke last year at this time, and you were pretty positive about the stock market into 2021. But were you even just a wee bit surprised about how well the market actually has done in 2021?
I think everyone has to be a little bit surprised in regards to the fact that we didn't have any material correction at all. I think that was a big to me because we were very bullish for this year just because we thought it was going to be a reopening trade. And so that met our expectation. But the biggest surprise was not seeing any material corrections in 2021. I think the biggest dip we saw was a 5% dip from peak to trough. So that was very surprising for us.
Yeah, if your philosophy was buy the dips in 2021, you had to have a pretty quick trigger finger, or otherwise things just came right back up again. So let's fast forward to next year. What are some of the surprises that you think we could see next year, and some of the things that could trigger those surprises?
So I think the biggest thing for 2021, and we have been warning investors for the last few weeks on this. And Dave, my nickname is Common Sense Bull, so I'm bullish a lot, but this is the most cautious I've been maybe in my career going into the new year, because I don't think the average investor realizes how surprised the higher risk plays in the market are going to react to a Fed that is going to be forced to taper faster while GDP is decelerating. I think everyone thinks this economy is bulletproof going into next year. We see a slowdown economically. And when you slow down economically while the Fed is tightening, you can't find a worst case scenario for high risk assets, in my opinion. So we are going into 2022 playing full defense more than I probably ever have in my career, because we think the market has sent a clear signal that defense is going to win next year.
So in some ways, it sounds like you're saying the Fed overreaction is truly the biggest threat moving forward, and you think that they will overreact for the most part.
They almost have to, Dave. They put themselves in a lose-lose situation. They had golden opportunities to start tapering while the economy was accelerating, and they did absolutely nothing. So now they have to accelerate their tapering, or we're going to have hyperinflation. So when they accelerate tapering during a slowdown, we're going to have a correction in the market of sizable proportion, in my opinion.
Yeah, we saw GDP growth, or real GDP growth, be 6% plus first quarter, second quarter. And of course, you're referring to the fact that in the third quarter it went down to 2%. So it sounds like you're saying that decrease in the GDP growth in the third quarter wasn't just because of concerns about the Omicron variant. You think there's other things affecting that slowdown, and that slowdown is likely to persist into next year.
Without question. And look, I have always said the bond market is smarter than the stock market, and the 2 and 10-year yields are starting to come together. We're seeing a flattening of the yield curve, 10 years coming in. It is telling us that we are heading into a slowdown. And I think the consumer is going to be really pinched next year. The cost of living has gone up substantially. So they're not going to have as much discretionary income in 2022 as they do in 2021. So all the dots are starting to connect that people are overestimating how strong the economy will be next year. We think the economy is going to slow down. And that rate of change on the slowdown is what the markets do not like.
So what if the Fed gets it right? What if the Fed gets it right and maybe they stop quantitative easing gradually over the first half of next year? They don't try to reduce their own balance sheet. Maybe they don't try to increase short-term rates. If the Fed gets it right, then how do you see things being different at that point? And that's a good thing, obviously, correct?
It is. Look, if they happen by some miracle, thread the needle exactly perfectly in one of the largest debt bubbles we've ever had in history, then we have nothing to worry about. But we base everything on probabilities. The probability of them being able to taper or tighten in a manner that doesn't disrupt the markets, it's not a bet I'm willing to take. I believe the probability of them not having a misstep is extremely, extremely low.
Well, you and I, over our careers, have both seen the Fed cause a lot of recessions. Sometimes they're the arsonist and the fireman all wrapped together, as I like to say. So what are some of the things you're doing then for your clients going into 2022 to try to protect them, to make them feel more secure, but yet to be agile enough in case the Fed surprises both of us and doesn't make that misstep?
So, Dave, that's a great question. And this is our point of what we've been doing with our asset allocations. Starting the day before Thanksgiving, we started reducing risk. So we've been actually selling the RIPs in November and December versus buying the dips. We have been getting out of small caps, mid caps. We've been reducing our energy exposure, and we are increasing exposures in things like utilities, healthcare, consumer staples. We'll be adding gold more than likely next year. So more of a boring portfolio. But if the market continues to go up, our opinion is those assets will still do okay. So you'll still do well. But if we get the correction that we expect, those types of solid asset allocation classes have a tendency to hold up much, much better than what we got rid of to get into there. So we are playing defense in the type of style factor that we have and trying to reduce our high risk exposure within our portfolios.
That's what I always love about you, Eddie. You always seem to know just when to be greedy and just when not to be greedy. And it sounds like you're saying now's the time not to be greedy. Eddie Ghabour, thank you so much for being with us here on the show. We really appreciate it.
Thank you, Dave.
Thanks for watching today's video on my 2022 market forecast. If you enjoyed it, click the thumbs up button to give us a like, and make sure that you subscribe to our YouTube channel for new content each and every week.